Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 13th of May. I'm Daniel Lam, your host for the podcast. Is this time for real? That must be the question in the mind of many investors in Hong Kong China equities. Yes, there has been a sharp move up in the Hang Seng Index since the middle of April, when it held the support at 16,000. But is this sustainable? Well, there are takers for both sides, in the views from various providers. Our view is that there are tactical opportunities available in the Hong Kong China equities, but for a longer-term sustainable uptrend, structural issues in the markets need to be resolved. Unlike most of 2023, economic surprises is once again the key driver of relative performance for Chinese equities year-to-date. Growth differentials have begun shifting in China's favor since April, particularly against the US, and in turn boosting Chinese stocks. The predominant factor behind the rise in Chinese economic surprises vis-a-vis the US is actually a sharp drop in the US economic surprise. So we've actually cornered the recent rally in Chinese equities as a near-term safe haven rally. Now, equity investors may focus on the direction of growth and thus continue rotating towards Chinese equities as the country displays near-term stability relative to other key global regions. Well, if anything, the issues in the Chinese economy has been well documented and digested, while slowdown in the US non-farm payroll figure, for example, still needs to be coming to be grasped with. Global equity investors' recent preference for Chinese stocks is also notable within the Asia and the EM space. So on a 3-month rolling basis, offshore inflow on the northbound Stock Connect channel have risen to $13 billion. That's the highest since early 2023, as investors trim their non-China equity bets. At the same time, margin balances for domestic investors actually fell during the most recent equity rebound. So again, this would suggest foreign demand was largely responsible for the latest moves. Now looking forward, systematic trend followers may get further behind Chinese equities in the weeks ahead because price momentum signals are usually slow to react to such sharp moves. So the trend-following funds are likely to be remaining buyers of the Chinese equity futures. Now technically, the Hang Seng Index has support at 18,298 and the 17,700 levels. Given the strong return of interest from foreign inflow, there can be larger rebound potential in the higher beta stocks. For example, on the Chinese internet space, as well as the technology hardware sectors. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.